Good afternoon once again. Maybe let me use this opportunity to wish everyone on the call a happy new year from Access Wealth Management. It's always a joy to come your way with these sessions. And this is the very first in the 2025 of our webinar series. And you can be rest assured that throughout the year, we'll be coming your way with other insightful topics. Today, we'll be looking at the 2025 annual economic and market outlook and what is in for you and I as investors. And to do that, we have resourced persons in the persons of Nanaria Febwama, Gideon Amweniche, and then Peter Bewa, last but not the least. I will be handing over very soon to Nana to begin the presentation so that we can move straight into action. As the presentations are ongoing, please share your questions and comments in the chat box, and we will address all of them before we leave the call. And on that note, I'd like to invite Nana Yafepuama, the manager at Access Pension Trust, to begin the presentations. Afterwards, Gideon will come in with an economic outlook and the market review for the US and other related markets. And then Peter will conclude with our outlook and projections in 2025. So Nana, can you confirm that you can hear me?
Yes, Opari, I can hear you. Can you also confirm?
Please. I can hear you loud and clear, and I can see your screen. So please take chat. Thank you.
Thank you. Thank you very much, Opari. So good afternoon once again, and thanks for making time to join this webinar. So today I will briefly introduce Access Wealth Management, explaining who we are and how we help our clients build and preserve their wealth. I would also take time to walk you through the historical performance of the US market. So Access Wealth is a wealth management firm based out in Accra, Ghana. We help our clients grow and preserve their wealth through tailored financial planning and also help them diversify geographically. And I'm sure if you've joined us this afternoon, you are either a client with investment in the global market or a prospective client looking to put your money to work globally. And our decision to invest globally, particularly in the US market, requires an understanding of the historical performance of various asset classes within our portfolio. Mark Twain, the renowned American writer and humorist, once said, "History does not repeat itself, but often rhymes." So whilst past performance is not a guarantee of future performance, we believe historical trend can provide valuable insight. So before we begin, I bet if we can move on to the next screen, I must note that this presentation will primarily focus on the US market, which currently accounts for about 59% of the global stock market. All right, so taking historical performance from 1928, the S&P 500 has delivered positive returns in 65 out of the 89 years, meaning in 73% of those years, the market recorded a gain. The table below present the historical average returns of key asset classes over 3 distinct periods, right? So if you take the 1928 period through to 2023, the S&P, including dividend, printed an 11.7% average return compared to 3.3 for US 3-month Treasury bills, 4.9 for the 10-year Treasury bond, 7.0 for an investment-grade corporate bond, 4.4 for real estate, and about 6.6 for gold, right? From 1974 through to 2023, historical average return on US stock increased to 12.5. Treasury bills, increased by 1.1% to 4.4. US 10-year note about 6.6. Corporate bond about 8.8. Real estate 5.6. Gold 8.4. And then from 2014 through, to date, you'd realize a slight increase in average US return from 12.5 for the preceding 50-year period to about 13. Treasury bills rate, fell mainly due, to the era of quantitative easing after the great, financial crisis. Bond return also fell during the same period. And the corporate bond return also fell. Real estate saw an improved performance, 7.1, and gold barely, unchanged from the 1928 period to date. Right, so the key lesson here is that long-term investors in broad market indices historically do not lose money, regardless of the asset classes they are invested in. And the data, confirms that equity remains the most effective wealth building asset over the long, term from the historical, return. However, average return alone do not capture how market behave under different economic conditions. So the next slide shows average returns during bullish years, right? And bullish years basically are years market performs positively. Again, over that 3 period, example, you'd realize when the market, is bullish between 1928 and 2023, market did 21%, i.e. equities, right? 74 through to 2023, about 19.2%, and then 2014 through to 2023, S&P, including dividend, did 19%, right? You realize the other, asset classes, definitely, lagged the performance, of equity, right? Gold proved to be an indeed, store of wealth. So if you check, for the period and the analysis, besides, equity, gold churned out, the greatest performance. So 14.2, 1928 through to 2023, 20.3, 1974 through to 2023, and then 2014 through to 2023, gold did, 11.4. Now, it is very, obvious that investing is not always smooth sailing. The next slide. And bear markets are inevitable, right? It would always, happen. So how does market, perform during bearish year? And I always like emphasizing bad returns because unfortunately, many Ghanaian investors, struggle with negative return in their portfolio. We never, want to see our portfolio, drop. And for me, that is not, investing, right? So for those same asset classes, when times are bad, the S&P over the 8-9, year, period, did negative 13.5. 50 years, back was 14.2. And then from 2014 through to 2023, about 11%. For US, Treasury bond, when times are bad, also negative, right? So negative across the 3, time frame. Corporate bonds, negative across the 3, time frame. Real estate, negative. Gold, negative, right? So for me, the lesson, here is, there's no, free lunch, right? We've been, used to amortize, return in this market. You buy, treasury bond, and we always expect positive, return. Yes, when you are holding to maturity, you get your principal, back if there's no default, right? And whilst you hold the bond, you collect your coupon. But then if you decide, to exit in between, you would either sell at a profit or a loss, depending on where interest rate, is. Equally, if you decide to buy an already issued bond, you can decide, you can either buy at a premium or a discount, depending on where interest rate is. So there's really, no free lunch. Bears are really, part of life. All right, so maybe on to, the next, slide, where I want to dwell a bit more on market cycles and expected volatility. So historical data, confirms that there have been 5 periods since 1880 where market delivered back-to-back 20% plus return, right? The most recent, period is just, 2023 and 2024. If you add, that, then we have, 6 periods where the market has delivered back-to-back 20 plus return, right? In 4 out of those 5 cases, the third year resulted in either a negative or a single, digit returns. Usually the third year following such strong performance tend to experience heightened volatility, particularly the second half of the year. And because I mentioned earlier on that Mark Twain, said, history rhyme, there's a reasonable probability that we would experience a year of low positive or even negative return with a lot of volatility. If you listen to market commentators, many seem to be anticipating bad news that could trigger a downward re-rating of risk assets. If this were not the case, why would an obvious misinformation campaign, such as the DeepSeek AI, false claim of spending 6 to 10 million, dollars compared to billions spent by US competitors, cause such turmoil in global market 2 days, ago? It seems the human, nature is wired, to expect and react to bad news. However, despite, these concerns, I remain optimistic about market, outlook. So the next question, really, is should we expect a bear market? And you see, the red highlight shows, the return following 2 years of stellar 20% plus, return. So it can be bad. However, if you check, the period, from 1995, it defied, that expectation. So 1995, market did 37%, 1996, 22.6%, 1997, 33%, 1998, 28%. We could as well, see, such, play out. Nobody knows. So on to the next slide. How do we basically, prepare, for bear market? To prepare for bear market, we need to understand what a bear market is. So a bear market is simply defined as sustained decline in market value of 20% or more, right? According to Edward Yardani's, research, the S&P 500 has experienced 21 bear markets since 1928, right? An average duration of bear market is about 14 years. So for, those of us here who are clients, if the bear should start, brace up, right? You would probably, suffer years or months of market drawdown. It's normal, right? The shortest bear market we've seen in history was in 1987, 1990, which lasted about 3 months, with the longest between 1946 and 1949, which persisted for about 3 years. About market, impact, right? The average loss during bear market is about 34%, right? So it's likely your $100 invested would end up to be about 66, right? The worst decline was seen during the great financial crisis, right? 2007, 2009, where market, tanked by 59%. And the shallowest was around 1990 when market, declined by 20%. And these are all, equity numbers, right? So Albert, on to the next slide. Right. Now, can bear erase, gains, right? History suggests that bear markets do not erase the substantial gain of bull market. So for context, bull lasts on average 60 months. And for those, 60 months, market rises by 165%, whereas, bear typically declines 13% over 14, months, period. So there's no way 33, can wipe 164. However, if you are a short-term investor, chasing trend, really this doesn't apply, to you, right? When a bear, happens, you would panic, you'd sell, and then you'll crystallize, your losses, right? We can only sympathize with you. But if you are invested for the long term, there's no way that would happen. Albert, on to the next slide. So, tips basically for navigating, bear markets. Stay invested. You cannot time, market, right? I'm sure somebody will be asking, since Nana, you're anticipating a drawdown in market, why don't you sell, right? It may not happen, right? And if I sell, when do I, enter? Secondly, assess your liquidity need. Don't put, money you need for emergency or urgent needs into market or into risky assets. Diversify your portfolio. You have some monies invested in Ghana, in your pension funds, in global, market. Albert, wait. Back, let's go back. And what I'm pretty much, interested in is have cash on the sideline, to invest at regular period, what we call dollar cost averaging, right? Keep some cash on the sideline. And that's when, market presents a buying opportunity, you invest, right? If you invest and market, goes up, both your new money and your old money enjoy the ride. On the contrary, if you invest and then market, takes, a beating downwards, your new money is able to acquire the same security, prices. So this is, just, about it, rebalance your portfolio, and that's what we are here to do. You see or seek strategic opportunities and keep, perspective. And this is to help you, keep perspective. If market tanks, do not panic. Over the long term, you will make money. Now, onto the, next slide. At Axis Wealth, how we help our clients is we invest our clients' money across model portfolios, depending on their risk, appetite. So we have aggressive growth income all the way through to conservative. And 24, onto the next slide, we feel, our model portfolio, performed, incredibly well. So our aggressive portfolio, did about 19.1% on a USD basis. The growth portfolio, did about 15.4%. Our yield portfolio, which is mainly, bonds, fixed income, did 4.78. Translated into CDs, it was good because of the massive depreciation we saw in our, currency. So we welcome the opportunity to engage you after this, call if you're interested in assessing, global, market. Thank you, very much. And Gideon, if you can kindly take over.
Hello, thank you very much, Nana, for the intro. Albert, if you can please move on to the executive summary. Okay, so good afternoon, everyone. So here I'll be taking you through what happened to our markets that we are invested in last year, and then also look at some of the economic indicators that shaped the year for us. In a nutshell, the summary story is last year we did see an impressive performance on our markets. If you look at the stock markets, the S&P turned out another 20%, which historically has not happened often. And this was largely supported by healthy growth that we saw across the globe and in developed markets that we are invested in. If you look at inflation levels also, most central banks were able to control inflation and keep it on a disinflationary trend. Monetary policy also went as expected. Largely in the US, we're expecting some rate cuts, which did happen. But inflation has some concerns, which we'll look at. If we can go to the next slide, please, Albert, for the details. So on global inflation, we've come from a high peak of about 8.73% just after the COVID pandemic hit. And after that, most actions has been to bring inflation on a downward path. If you look at the graph indicated here, you can see that inflation has gradually been on a disinflationary trend. 2024 still remains a forecast because we haven't received the actual, but predictive data suggests we are somewhere around 5.9%. 2025 is even expected to trend lower. And we know what inflation does. It reduces our purchasing power as investors and even, citizens. So we are expecting inflation to keep the downward trend. If you look at, some regional figures that we have, focusing on the US, the latest point for inflation that came out was 2.9%. And this was largely in line with investor expectation. Most analysts were expecting this. So it doesn't really affect inflation expectations going forward. And it's a similar story for the Euro area, where the latest print we have is 2.4%. And we have such similar stories across emerging market areas. So generally, we see inflation on a downward trend, and that is healthy, for our markets and investors. I'll move on to the next slide, where I'll talk about the effects of this inflationary trend that we are seeing. And some monetary policy actions that have been taken, and that also signals the direction of interest rates. If we focus on the US, last year from September to year end, we did see about 3 rate cuts. For this year, they are even expecting some more, despite, just that inflationary concerns has, risen. And so the number of rate cuts that are expected are likely to be reduced. It's a similar story for the Euro area, where monetary policy has, been easing, and we are still expecting them to initiate some further cuts or reductions this year. Emerging markets area, broadly, it has been a mix of some tightening against some easing, but the general trend has been to ease monetary policy to allow inflationary pressures to also keep going downwards. Most areas within the emerging markets area have had to also take a pause on further cuts because inflationary pressures or inflation has been sticky in those areas. If you're looking at the impact of this inflationary pressures against monetary policy action, the next slide gives us details on how these have affected growth around the regions that we are invested in. If you can move to the next slide. So on growth, if we narrow down to the areas where we usually stay invested, largely in the US though, but we keep a watch on the Euro area and emerging markets area. The latest prints that came out showed US still did record a healthy growth of 3.1%. If you compare it to the previous quarter, that was around 3%. And historical trends seem to suggest, even though there has been some reduction in growth, this still remains at a healthy level. Going forward, I think growth should still remain strong. And growth has largely been driven by consumer spending and some business investments that are ongoing within the US. For the Euro area, even though what we are seeing here seems quite low, that has also been an encouraging trend in the 0.4% growth. And consumer spending also plays a critical factor in the growth that we are seeing here. Emerging markets area, we are looking at somewhere around 0.75, and this is just an index, but this largely shows that even though there have been some tightening and trying to control inflation, growth has also not really been impacted. I think most people expected some recession. Fortunately, we have also seen expansion going on throughout the year for, the various quarterly releases that we saw. I would move on to just talk about how these factors shape the markets that we are invested in. And focusing on the equities market, like I did introduce earlier, we did see an impressive performance. For the full year, the S&P 500 recorded a return of 25%. If you look at the quarterly breakdown, the first 3 quarters, even though we saw some marginal declining, they were very good for, the various indices we are seeing in here. I think a lot of the issues happened in the fourth quarter, especially for the S&P or the stock market. We did see some rallies go on just after the US election. However, after the Fed, did signal that further rate cuts are not going to be as expected, I think markets reacted, and that slowed down returns across all the indices we are seeing here. However, it's important to note that within the emerging markets area and the EU area, growth or returns in the US were largely stronger. So US markets, did perform better across the globe. I'll just move on to the fixed income market. And that's also, a similar story that played in here. The first 3 quarters did see a very good performance across some of the duration indexes that we are seeing in here. For the fourth quarter, if you compare across board, you see that there was some volatility introduced in here. However, on a year to date, if you did stay invested, despite the expected rate cuts and all that, US bond markets did record a positive performance. So if you look at it across both the equities markets, both the fixed income markets, returns were largely positive. The first 3 quarters were strong performances. We did see some drawdowns within the last quarter, but largely returns were strong overall the year. I think that brings this presentation to an end and sets the foundation for Peter to give us the outlook. So thank you very much, and see you in the question time.
Thank you, Gideon. Thank you to all of our participants for taking time out of your busy schedules to spend some time with us today, this afternoon or this morning, depending on where you are. So I'm going to go over our outlook for the year 2025 and our projections, where we see investment opportunities, and where we think we should be, investing going forward. Next slide, please. Now, before I do that, I would like to just go over a little bit of the macro, backdrop currently persisting, to give us, an idea of why we are bullish and what some of the risks we should be wary of. So I want to start with inflation at this point, and also just to reiterate what Gideon just alluded to. Inflation has been slowing globally. Here in the US, it's gone from around 9% in 2022 to just around 3% last year. We expect the trend to continue to slow and get closer to the Fed's, inflation target, which is 2%. And the reason why we continue to think inflation is going to slow down is a lot of the factors or the components of inflation continue to trend down. And so energy prices have been going down. Energy affects every aspect of the economy. With energy prices going down, most things that are impacted by energy are also going to be affected in a positive way. The biggest components of inflation here in the US is housing or shelter cost. There's been a shortage of housing in the market, especially multifamily homes. But there's a huge drive by various governments and agencies to reduce regulatory impediments and enhance building of new, homes across the country. And that is going to drive down, rent and just the cost of housing in general. So we continue to think that inflation is going to continue to trend, lower towards the Fed's target. So that's inflation. The next in the current macro backdrop is the Fed's easing cycle. So we saw the Fed hike rates after the pandemic when inflation was around 9%, and they paused for the longest time and started cutting rates again last year. And they did 3 rate cuts from September to December. We think that the Fed is continuing to ease. We think that the Fed is going to cut rates this year, although it may not be as much as the markets expect. They don't want to cut too early, and inflation raises its head again, and then they have to go back and start raising. So there's a lot of uncertainty with the current, Trump administration as far as trade tariffs and also immigration and other issues going on. And so they don't want to be too quick, to catch rate and have to raise it again. But the Fed is in an easing cycle. Rates coming down bode well for the equity markets because it makes cost of money, cheaper. Makes the value of equities, higher, and so it justifies higher stock prices. So when rates come down, we see that it impacts equities in a positive way. And so with the Fed, currently easing, that bodes well for the markets in general. We also see a strong GDP print. And so GDP continues to trend positively. The last revision of Q3 GDP was revised higher from 2.8 to 3 or 3.1%. Economists define recession as 2 consecutive quarters of negative GDP growth. So we are nowhere near a recession at this point. Before a recession can happen, the GDP for the quarter has to be negative, and that has to happen 2 consecutive times. Now, with a GDP at 3%, we are nowhere near negative, and we expect that GDP continue to grow this year as well. And so those are all factors that point to a strong economy and keeps us optimistic about the markets. The other factor that we want to look at is deregulation from the current Trump administration. So there's a lot of market-friendly policies that the current administration is proposing, including reducing regulatory burdens. So there's going to be a lot of cancellation of some of the regulations that markets don't like, basically. And some of the areas that is going to impact include energy. So there's going to be a lot of opportunities for energy companies to drill more and produce more oil. That is also likely to increase supply of energy and reduce the prices. There's also going to be a lot of deregulation when it comes to financial services. And so the banks will be able to make more loans, do more business. There is a lot of expectations of mergers and acquisitions. So M&A activity is going to increase, and that all bodes well for the financial markets. That's going to generate a lot of investable funds in the markets, and that all helps to drive equity markets. So those are all positive developments that we expect to happen as the year goes on. The two main wild cards with the current administration is trades and tariffs. And so the administration is announced a lot of tariffs on trading partners, and we think that a lot of these are being used as bargaining power or bargaining chips in order to get certain concessions from different trading partners. But as to whether those tariffs are actually going to be imposed is still up in the air. But if they do get imposed, it's likely to be retaliation. So that's a wild card that could impact the equity markets in a negative way. So that's something to keep an eye on. But most analysts think that they're just being used as bargaining chips. The other wild card will be immigration, which has already started. So the administration has already started deporting, illegal immigrants. They said they're focusing on those that have committed crimes first, but nobody knows how far that's going to go and who's going to be impacted. But that is likely to lead to labor shortages and could also lead to inflationary pressures. So immigration and trade and tariffs are the two major potential risks to the markets that we want to keep a close eye on. But with all that being said, the administration would not want the markets to tank on their watch. They want the momentum to continue. I mean, Trump is inheriting a very strong economy in spite of everything that has been said, and the economy continues to grow, and they don't want to be the ones to tank the economy. So they're going to do whatever it takes to keep the momentum going, and if possible, even juice up the economy. Next slide, please. So with all that being said, where do we see the investment opportunities? The US continues to be, the strongest economy and the largest economy in the world. There is still a lot of opportunities to invest here. The economy continues to be steady. Corporate profits continue to be solid. Earnings, keep coming in better than expected. So just last week, the banks, started reporting, and all of the major banks reported record profits once again. And we continue that trend to continue. This week is going to be the busiest week as far as earnings go for the S&P 500 components. Most of them are going to be tech names. We do expect that earnings is going to be strong to justify the run up in prices that we've seen over the last quarter. We also expect the market-friendly policies from the current administration to help support the market. The big risk currently is how valuations have been stretched in certain areas in the market. So like some of the tech valuations, markets have kind of gone ahead of themselves. And so there's a little bit of stretched, price to earnings currently. But if earnings come in, stronger than expected, then those can be, justified. And that's why when there's any black swan in the market, or there's any unforeseen event like what happened on Monday with the DeepSeek, the companies or the stocks that have had a very strong run are the ones that pull back significantly because the prices become very, very uncertain. And so that's why we saw on Monday a major pullback in the tech names. So that continues to be one of the risks to keep an eye on as far as how stretched valuations are. But like I said, if earnings continue to come in stronger than expected, then those prices can be justified. NVIDIA has been the poster child of the AI phenomenon. But each time so far, each earnings release has been better than expected over the last at least 4 or 5 quarters. So the markets have raised their expectations, but then the earnings come in way better than they even expected. So the US continues to be our main investing destination at this point. There's a lot of opportunities here. There's a lot of innovation still going on, and the markets continue to be very, very stable. And so that's where most of the opportunities we currently see, exist. However, a lot of these companies are also have operations, globally, and so a lot of their revenue generated outside of the US. A lot of the multinationals here in the US have at least 30 to 40% of their markets, outside of the US market. So they are US domiciled firms, but they are global, in nature. So investing in the US does not necessarily mean you're only exposed to the US market. You're also exposed to global markets. We do see opportunities in developed international as well, talking about, developed Europe and also, Japan. But that part of the market, is not as strong and as stable as here in the US. But we see a lot of opportunities in pockets of those markets. Luxury goods, for instance, Europeans produce the best luxury goods in the world. We see opportunities in some of these clothing brands, or luxury cars, or even some of the banks. We actually see opportunities in some of the chip manufacturers also in Europe. And so we do have some exposure in the European market. But it's a very, very, niche space. You don't want to be just invested in a broad market. You want to be selective. However, one of the risks with investing outside of the US is that the strong dollar tends to, eat away some of the, rewards that you get from investing in other markets. The dollar continues to be strong. Over time, it's supposed to revert to the mean, but it's been trending, in that direction for a long time, and we don't know how long that's going to be. But as long as the domestic policies here in the US continue to drive up the dollar, it makes investing in the dollar or the US markets very, very attractive. Because when you convert it back to your local currency, it compounds your return. We also like pockets of emerging markets, specifically India and parts of South America. And that's largely due to reshoring since the pandemic and the supply chain bottlenecks that occurred. A lot of companies have diversified away from relying on China for all of their components. And so there's a lot of industrial development in other parts of the US, other parts of the globe, especially emerging markets. The factors that favor emerging markets are, the demographics continue to be very, very attractive. They have the youngest populations compared to the US and Europe, and then labor is really cheap. And so a lot of companies are investing in infrastructure in those areas to show up, manufacturing. Apple, for instance, has done a lot to build up, capacity in India in order to diversify away from their reliance on China. The big risk to emerging markets is, some of these trade and tariff policies from the US government may impact them negatively. We also see a lot of geopolitical tension, that continues to be, headwinds with emerging markets. Next slide, please. So this all boils down to, what sectors that we actually like and which areas we are, avoiding or reducing our exposures to. And so tactically, we believe we want to be overweight to technology space. So the AI phenomenon is still in an early innings. And in spite of what, the Chinese company announced early this week about, with DeepSeek and how little they invested in order to be able to compete with ChatGPT. We still think that the sector or the space is still very, very early. There's going to be a lot of investments in there, and the runway for that phenomenon is very, very long. So there is opportunities to invest in AI, opportunities to invest in chip manufacturers, and also the software. Another area in the tech space is cybersecurity. We all hear, day in, day out, how big companies and organizations are getting hacked, and so there's a lot of investments going into providing, security in the cyberspace. And so that theme continues to be one of the attractive investment themes in the tech space. Now, with technology continuing to grow, we like industrials because it's also the way to provide infrastructure for the tech space. And so a lot of the next iteration of AI is building up data centers that are going to house some of these, huge tech, infrastructure. There's also development of energy for these data centers. So industrials continues to be one of the areas that we like a lot. The next will be financials. Like I said, deregulation from the current administration and M&A activities is going to really bode well for financials. We're going to see a lot of the mergers and acquisitions. You're going to see a lot of banks starting to lend again and actually making money for their shareholders. So financials is one area that we like in this current administration. The sectors that we underweight to include staples. As inflation continues to trend low and unemployment continues to be low, staples will not likely do well because when goods and services become cheap, most people can afford to, actually buy, slightly more expensive, goods. They like to, trade higher. We also don't like, or we underweight to healthcare because of there's likely to be more regulation in the healthcare space. The new secretary or the designated secretary for healthcare is going to be vetted today. So RFK, Robert F. Kennedy Jr., and he is, proposing a lot of regulations that are going to likely not bode well for the space. And so that's one area that we want to be underweight or be very careful which companies you want to invest in. Utilities as a sector also are not as attractive when rates are staying high for longer. So with the Fed easing, we still think that rates are it's not gonna be as quickly as markets had anticipated. And so we think that rates are going to remain high for quite a while before they go back down to, what it was before the pandemic. And so it makes utilities not as attractive. So those are areas that we want to be underweight to. Other sectors that are not mentioned here, we're neutral. But with all that being said, this is going to be an active investors market. It's not going to be, a rising tide lifting all boats where everything's going to do well. And so that makes, you having a financial advisor who can pick, the winners and losers, for you comes in very, very handy. And so next slide, please. And so this will, come to the end of my portion, and I'll turn it back to Isaac to take care of the Q&A. Thank you for your time.
Thank you very much, Peter, and thank you for Gideon and Nana for your earlier insightful presentations. We like the interaction that is following. So I'll go ahead and start quickly with the Q&A so we can make maximum use of time. And Peter, since okay, let me give this to Nana. Nana, somebody wants to know the measures that have been put in place to shield the portfolios for the effects of a potential extended bear market. If you can please address that for me, Nana.
Hi, yeah. So thanks. So I think Peter, mentioned in his conclusion that it is really an active, market. It's basically an active market, right? So you need to, pick and choose, which sector you want to expose, your money to. Secondly, like I mentioned, we don't have control, right, on bear market. Nobody, has control. Nobody can call a bear market. I remember if you've watched, there's this movie on the financial crisis. It was obvious the housing sector was overheated, right? And people started, making, moves to protect their portfolio. Some bought, credit default swap. They were expecting, the recession, to happen right there and then. It took, almost 18 months for the housing sector thing to crystallize. So it is difficult, to call, when a recession or bear market, would happen. So the only safeguard is what, I spoke about. Have liquidity in place so you don't have to draw down your portfolio to meet emergency needs. Have cash. You can invest in market when market, takes, a beating, right? And the best, years we've seen in market is a period following the great financial, crisis. When you have money ready to invest after a bear market, you are basically, set up, for life. So keep cash, ideal. If you know, you're already invested with us and you are very sensitive, to market decline, And if you invested in anything aggressive, I mean, for you, I mean, just reach out. We'll just reach your portfolio, or we'll talk. We'll talk and then see what we can do, I mean, for you, basically. But then for the ultra, I mean, risk averse, I mean, the only way out, I mean, really is treasury bills. And are you happy with a 3% per annum return on treasury bills, right? With our fees of 1.5%, because that one will take, right? So it is difficult. Just keep perspective. I mean, keep invested, have cash on the sideline, and then we can use the cash, I mean, to buy when market, I mean, tanks, right? Should the bear, I mean, market, I mean, happen. Thank you.
Okay, thank you very much, Nana. So I think Opare is having a challenge with his microphone. So I'll pose the next question, which I would answer myself. It says, should we be focused on US dollar assets in 2025 or strongly consider CD assets as well? Okay, so my answer to this is I would like to analyze from the broad characteristics of investing in dollar assets and then investing in the CD assets. If you invest in the dollar is widely known to be a stronger currency and a much more stable one. So it's mostly characterized as a safe haven asset. Whereas, I mean, if you look at the CD, it has a higher risk. It's quite volatile, but also, I mean, comes with a higher return. So it's not a straightforward answer as in focus on dollar or CD. I think we can have that further conversation based on what your investment goal is, what your investment objective, time horizon, risk profile is. We can have a deeper conversation to provide a much more precise answer to that. But I mean, US dollar assets are known to be stronger and much more stable. So if you are not looking for a lot of volatility with your investments, I think you should focus on dollar assets. Currently, CD investments are giving higher return, but we are also in a recovery mode. We are still exposed to, I mean, external shocks. Any small shock that hits us, we can, I mean, be thrown away or off our recovery path. So, I mean, it's a decision between wanting to invest in a stronger and stable currency against a higher return but higher risk currency or environment. So we can, I mean, have a backstage conversation to help you with a definite answer which will fit your situation. Thank you.
Thank you very much, Gideon, and thank you for stepping in for me. Peter, so you spoke about the prospect, etc. Somebody wants you to go further in details and help him. He wants to know which companies are likely to outperform or be potential breakout stocks in 2025. Let me read it again. Which individual companies are likely to outperform or be potential breakout stocks in 2025?
So thank you for the question. That's a very, very difficult question to answer. We have companies that we like based on our screening process. That's not something that we can share in a public forum. But every sector, has companies that have higher prospects of outperforming the sector or the industry, and some that are not, based on various metrics. But depending on what sector and depending on the investment profile, that will determine what companies to mention. Given such names in a public forum like this could constitute giving investment advice, and it may not be right for everybody on the call. And so this is done on a individual basis, based on the client profile. So that's how I'll answer this question at this point. But we have companies that we like. Obviously, we're not invested in the whole S&P 500. We have specific companies that we like in each sector that we invested in, and that's where talking to an advisor comes in very, very handy. So I hope, that answers your question. Thank you.
Peter, thank you. Thank you. But before you go, just related to that and giving the nature of the answer you gave, somebody wants to know then, what are the key fundamentals you look for in listed companies? Just so yes, you won't be able to mention the companies, but what do you look out for before you invested in companies or before you make your selection?
Okay, so that's a really good question. So we look at, we combine both fundamentals and technicals. And technicals, we're looking at, the trend, of the company's, trading chart. Trends will give you an indication of what is going to happen over the next, 6 months to a year, basically, how the stock is trading. So that's what the technical aspects entail. And then on the fundamentals, we're looking at companies with very strong, reliable, long-term cash flow. The cash flow has to be strong. We want to look at what the business model is about. And so we have what we call economic moat. And we want a company with a strong economic moat. Economic moat simply means that the company is very, very competitive on a long-term basis. And so we're looking at, the business model surviving the next 10 years or more. That means that it's a strong economic moat. It can fend off competition. And then we also look at the corporate governance. So history and research has shown that companies with very, very strong corporate governance have outperformed their peers. And so we want a company that has really, really good, corporate governance. And that simply means that they are putting the interest of their shareholders before their own, interests. And so they are working for their shareholders. That's what, corporate governance simply entails. And so they're doing what is right, that is going to sustain, the business. So cash flow, economic moat, corporate governance, those are the three main things that we look on the fundamental side. And then we also add technical analysis. And so that's the main driver of our stock selection process. And there's other factors that we look at as well, but these are the main factors that we focus on. I hope that answers your question.
Thank you, Peter. Nana, and before Nana, we kindly want to ask for just 10 minutes so that we can answer all the questions that we have in the chat box. This was supposed to have ended at 1 p.m., but please bear with us. In the next 10 minutes, we should wrap up. Nana, I have a question for you, please. Are there plans to invest in China, given its strong and growing economic power globally?
Yeah. Good. Question. Good question. Maybe I'll just, say a word or two, and Peter can jump in. Over the last, 30 years, I heard somebody, saying that if you've invested in the Chinese market, you are basically flat, right? You are basically, flat. Because of, obviously, certain, constraints, right? You won't wake up to hear, President Trump is clamping down on Elon Musk or some billionaire, because the billionaire, is criticizing, the government. You dare not, do that in China. So, that, in my view, the lack of openness makes it a bit uninvestable. Nonetheless, like we say, the only free lunch when it comes to investing is diversification. So yes, having some little exposure to China will not be bad. Of course, through ETFs, because you barely, will understand, individual companies barely will understand their financials to make bets on individual companies. But you can buy an ETF that gives you Chinese exposure, but then it should be, as minimal as possible in your portfolio. Maybe Peter, can just jump in and then say more on that.
Yeah,
Thank
so
you,
what
Nana. Peter, yes, Peter,
I'll
please.
add to Nana's comments is, so we do like the Chinese consumer, not necessarily the Chinese government. And so there's a distinction. So there's a lot of investment opportunities that, involve the Chinese consumer. They still have a very, very young population. The unemployment rate is really, really low, and that is what has sorry, the unemployment rate is really, really high. So that is what is has been a drag on the Chinese consumer at this point. But the burgeoning middle class provides a lot of opportunities. And there's a reason why, Elon Musk's Tesla has, their biggest, market in China because of the opportunities there. However, you have to be wary of what, risks are entailed in investing in China. There's a lot of intervention or with the Chinese Communist Party. They can just decide one day to, kneecap you. That's what they did to Alibaba. We liked Alibaba years ago until Jack Ma made some comments attacking the Chinese government, and that was the end of him. And so you have to be wary what areas you're investing in China. But we do see opportunities in the Chinese markets as far as the consumers go, and anything that is government controlled, we want to be careful. The only thing that I'll add to that also is that one of the reasons why China has struggled recently is the stimulus. So they've not really recovered, well from the pandemic. When they locked down the whole economy during the pandemic, the economic activity almost came to a halt. And so when they reopened, they were late to reopen in the first place. And then when they reopened, the stimulus that was expected to be pumped into the economy did not materialize. And so it's made investing in China not as attractive as it was pre-pandemic. And then when you juxtapose that with the fact that a lot of countries are bringing manufacturing back to their shores, it reduces the investment drive that China enjoyed over the last 3 to 4 decades. So there's still opportunities there, but it's not as much as it used to be, in the decades ago. So that's how I will answer that question. Also, to the next point, you can get exposure to China through some of these ETFs, but it's still an active, investors, market. So those are my comments on that. Hope that answers your question.
Yes, sir. Thank you very much. So, Peter, please, before you go, so to you and Nana, there's a question here. Is it advisable for those who are sensitive to market declines to switch some of their assets to bonds or money market or gold in anticipation of a bear market? If you can comment on that, and maybe I'll take a comment from Nana too before I go to Gideon.
That's a great question, and that was what I was thinking about when I was answering the first, question. So first of all, investing requires, the luxury of time. Okay, you need to have the time horizon in order to enjoy or, benefit from investing in risky assets. And what do I mean by time horizon? If you are very close to retirement, say you are less than 5 years away from retirement, you should have very, very minimum investments in the equity markets. Most of your investments should be in fixed income or money markets. If you need the money for a major purchase, for instance, say you're going to be buying a house in less than a year, that money shouldn't be in the markets in the first place. Okay, so the individual's investment time horizon and the goals for the investing should be considered before you decide to put it in the markets or not. But the reason why I say this is equity markets go up and down. But over a cycle of 3 to 5 years, on average, a lot of the times, longer than that, markets do go up. And if you have the luxury of time, when markets pull back, that's when you're able to buy, stocks that have been, trading at all-time highs, very cheap. And with time, it's gonna go back up, and then that's when you benefit from, long-term returns. But if you need the money in the next 2 years, I suggest that, you don't put those monies in the risky assets. You should put them in more conservative assets. And so to answer your question, depending on the time horizon that you have, and when you need those funds and what you're going to use them for, you don't want to be exposed to risky assets, especially at a time when we expect volatility to increase and we expect, the likelihood of a bear market is high. Nobody is calling one anytime soon. On the contrary, we still think that this year is we're going to have another positive year, but nobody knows what's going to happen. And so if you don't have the luxury of time on your side, I suggest that, being conservative in your approach to investing is a prudent thing to do.
Absolutely.
Thank you. Thank you.
Just to add to that, but just so we know, if you are investing in bonds, right, you are only assured only to the extent that you are holding to maturity. Because in between, when you buy and it matures, in global markets, there's mark to market, right? So you'll see the ups and downs. You only get your initial principal, back when you are waiting to maturity. So just wanted to add that.
Thank you.
Thank you.
Thank you, Nana. Nana, just before you go, would you say short-term investment in utilities would be a good choice before the Fed rate sets in?
I'll let Peter handle that.
Okay. All right, sure, Peter.
So it depends. If you can get 5% or more from money markets, which comes with almost no risk, or very, very limited risk compared to utilities. Why would you put it in utilities? Investing in utilities, the attraction for utilities is that they pay high dividends, right? And so you can get dividends of maybe 4%, 5%, sometimes even 6% from utilities. However, there's still an equity, investment. So when you're getting the dividends, but then the actual price of the stock, drops, you're gonna sell it at a loss. Compared to investing in money markets, for instance, at this point with where the 10-year rate is currently, you can get 5% or more in the money markets, which you can sell at any time without incurring much of a loss, because it's basically, for the most part, US Treasuries. And so the risk reward favors investing in money markets compared to utilities at this point. The reason why utilities usually get attractive is when rates are low. Instead of getting 2% from money markets, for instance, you want to get 4 or 5% from utilities. For dividend seeker, you need dividends. But if you're getting a coupon or you're getting dividends from money markets, then the trade risk, risk return profile favors money markets versus utilities. So you have to look at both options critically and decide what you're actually trying to achieve to make that decision. So that would be my answer to that.
Thank you very much, Peter. And also, so we're getting to the end. We'll take the last question from or to Gideon, and then we can bring the session to a close. So Gideon, then some want to know what our key considerations for effective wealth management will be in 2025, and how they can optimize their investments in 2025. So if you can take that.
Okay, thank you very much, Opare. So if I'll speak from an investor's perspective, for effective wealth management, I think the first thing is to make sure you stick to your financial plan. You should have your goals clearly stated. You should have your resources and your surplus income well accounted for, just to start with. After that, I think the next option is how you are going to execute your financial plan. And for that, you need advice on where opportunities are in the market. From our side, we constantly monitor the market to to look out for good opportunities, and we monitor things like economic trends, news happening around the globe, geopolitical conflicts and tensions that are arising every now and then. There are a whole lot of factors we consider, but to just sum it up, for someone who is also looking at improving his wealth management 2025, have your goals clearly stated, have a very strong and well-labeled financial plan done for you. And I would say that at Axis Wealth Management, we do offer financial planning for free. So you can call us anytime. We'll just take you through the process and get you your financial plan. And then also keep your eyes on the market just like we do. Thank you.
Okay, thank you so much for hanging out with us this afternoon. We want to assure you that we'll be with you throughout the year. So somewhere later in the year, somewhere in April, we'll be coming your way with another exciting webinar in this series. It's been great having you join us from your busy schedules. We also want to thank our facilitators, that is Nana, Gideon, and then Peter, for sharing with us their thoughts on the economic outlook for 2025. On that note, we'd like to bring the curtain down and to thank you so much. As Gideon mentioned, you can reach out to us and we'll help you with your financial planning, a free financial planning exercise. And then beyond that, you can make your decisions in 2025. It's been great sharing our afternoon with you. We'll see you again in April when we have our next webinar. Thank you and have a good day.